In today's class, we will be looking at the preparation of budgets. This is a component under management accounting. Remember, we started off with management accounting, and then we say that we will come back later and now finish off with the budgeting after we've done the asset management bit. So today we will be looking at budgets, and under budgets we will be looking at what budgets are, why they are useful in the business, how the procurement department helps, or what is the role of the procurement department. When it comes to budgeting, does procurement department play any role when it comes to budgeting? And then we look at the various types of budgets that exist in business and also prepare some of these budgets. So we shall start off with, of course, the definition of a budget. I'm sure we are all aware of what a budget is. And essentially, a budget is a plan about the expected costs of the business in the future, and also forecasted revenues and forecasted sales for a company. You will find that it is common for businesses to anticipate in future how much are we likely to produce, and for us to be able to produce these units, how much are we going to spend, and how much are we going to spend, and also how much resources do we need. And then also they might want to forecast about their sales, that we want to sell a certain number of units, or we want to have a certain level of sales revenue. So therefore, how many units do we need to produce, and how much profit are we likely to have with regard to those sales. So we can officially define a budget as a plan that has been quantified in monetary terms and is prepared and approved prior to a defined period of time, usually showing planned income to be generated and expenditure to be incurred during the period, and also the capital employed to attain a given objective. That when you're planning for these units that we want to produce, or that the business would like to produce, then there is that aspect of quantifying it, that in this case, we want to produce, let's say, 50,000 units. So once you have said that you want to produce 50,000 units, then there are resources that are required to produce these 50,000 units. So you find that you're going to incur how much in terms of materials, how much in terms of labor to produce these units that you are intending to produce and sell. So you quantify it in terms of units, and then now you quantify this production or these sales in terms of monetary figures, that, for example, to produce these 20,000 units, then this is the total cost. If you wanted to sell these 20,000 units, you are likely to sell at this price. So this is the forecasted sale. So that plan that you're quantifying it in terms of monetary terms, and you find that you prepare it prior to the actual period, is what we classify as a budget. We can also say that a budget is essentially a plan to action, to achieve a plan of action to achieve stated objectives based on a predetermined series of related assumptions, that what you're planning to achieve in the future. The business is planning to produce a certain number of units. The business is planning to sell a certain number of units. The business is planning to have a certain level of sales revenue. So given that as the case, then we have to now know how to prepare budgets. And you'll find that, again, because of we're looking at, you guys are doing procurement, and then also we're looking at asset management bit, you'll find that the assets of the business are usually not that cheap. Most assets, especially the non-current assets, are not that cheap. So it means that the business always has to plan ahead in time. And now that just budgeting and planning ahead in time will tell the business how much resources are you going to require in a given period of time. And therefore, can we be able to plan ahead for the funds that will be required to get these assets, the plan that will be required to buy these, the funds that will be required to buy these raw materials in the future. So that is what we classify as a budget. So the next thing that we look at is the purposes of budgets. Why is it important for businesses to prepare budgets? Why not just work with things the way they go? Why not just wait for you to incur the cost before you record it? Why not wait for you to make the sales before you record? Why is it important to plan ahead and quantify these amounts that you expect to spend in future, or the revenues that you expect to receive in your business in future? So the reason as to why businesses usually prepare budgets is because budgets usually help to do various factors, or they help in various ways within the organization. And the first one is that it helps to communicate the management's plan throughout the organization. We have so many types of budgets, as you're going to see. We have the sales budget, we have the production budget, we have the labor's budget, we have the materials budget. So by just looking at the budget, you can be able to see, for example, in terms of production, how many units does the business intend to produce. So if you see that the budget shows that you're supposed to produce 50,000 units in a given period, then it means that this one is communicating to the various concerned personnel that at this point, this is how much the business requires to produce, and therefore we have to now work this hard in order to now fulfill that plan that the management has created. So that case, we call it, or we say that budgets now help to communicate the management's plan to the organization. It just tells the other levels of management, the other levels within the organization, what the management expects of them. Then we also have that these budgets, they force the managers to think and plan for the future. When you're creating the budgets, you're thinking for these budgets, if, for example, is the sales budget, you're thinking we want to produce 1,000 units or 10,000 units. How are we going to be able to achieve that? We want to sell 100,000 units. How will you be able to achieve that? So you don't just have an increase in your sales without making an effort for your business. You have to actually just think about the future, think about how you can be able to increase your advertising and marketing efforts so as to attract the customers. So it plays a very important role in just forcing the managers to think and plan for the future. And when now the organization is able to plan for the future, they're able to develop some strategic goals that will help in achieving success for the firm. Then we also have, it helps to allocate resources where they can be used most effectively. You find that in most cases, businesses have limited resources, and these limited resources have unlimited needs and unlimited wants. So it means that the business might be having so many projects at the same time. All these projects require resources, but the organization does not have the capacity to fund all these projects. So by creating a budget, you're able to see this project requires this amount, this project requires this amount, this is how much this project is likely to bring back. And as a result of that, you are able to do what you're able now to put the resources where there's going to be more returns, where you're likely to find more profits associated with that particular project. So it helps to put the resources or allocate the resources of the business in those activities that are likely to be most effectively. And then also the budgets usually help in uncovering some potential bottlenecks. And in this case, bottlenecks refers to those challenges that businesses are likely to experience when they're handling different types of activities. You find that within the organization, sometimes there could be some policies, too much rigidity within the organization that is now causing things not to be effective within the organization. So it means that now if you have now maybe issues, challenges that now are making it impossible for work to be undertaken efficiently within the organization, or it is acting as a hindrance to achievement of efficiency within the firm, then this budget will be able to uncover those issues. And then now from there on, you can be able to develop a systematic way to effectively and efficiently now perform roles within the organization. Then you also have, it helps in coordinating the activities of the entire organization, because within that particular budget, you're able to identify exactly what is needed. For example, if it is a production budget, you'll see that in the production budget, this one now entails how many units need to be produced and what will be the cost. So in this case, this production budget tells the factory personnel or the employees in the factory that this is how much work you're supposed to put in. It also tells the procurement department, for example, that you need to provide a certain number of resources or certain number of raw materials for these goods to be produced. It will also tell the finance department that you need to avail certain amount of funds so that we can be able to buy these raw materials, so that now we can be able to sell them off, produce and then sell them off. It is also going to tell the sales and marketing department that once these goods are produced, then you need to make efforts to make sure that these products are actually sold. So it means that it means that the budgets themselves, they play a very major role. They play a very major role in now just doing a coordination that, yes, it's one plan, it is one budget, but this budget sends signals to each and every department within the organization on how they are expected to play a role in achieving those targets that have been set up in the budget. And then the last one is that it serves as a benchmark for evaluating subsequent performance, that we will be now looking, and we did variances. I remember we did variances, and we say that variances, this is whereby we are comparing the actual results with the budgeted results. So it means that when you are creating a budget, you're able to establish how much the business was supposed to produce, how much they actually produced, how much sales revenue they were supposed to make according to the budget, and how much they were actually able to make, how much costs they were supposed to incur, and how much they actually incurred in terms of cost during that particular period. So those are some of the various reasons or purposes of having a budget within a given organization. Then the next thing that I need us to look at and define is what we call budgetary control systems. And we can say that a budgetary control is essentially a method of managing costs through preparation of budgets. That activity of comparing what has been budgeted and what the actual results was, in order to identify any variances, in order to identify any discrepancies between what was expected and what was actually obtained, in order to devise a way forward, especially if you've not been able to achieve the target that was in the budget, is what we classify as a budgetary control. That yes, you have set a budget, you wanted to incur costs, for example, of 100,000 Kenya shillings, you ended up spending 180,000 Kenya shillings. This is 80,000 over and above the budget. So if now you are over the budget, you now go back and just look and scrutinize and investigate. Why is it that now we had budgeted for 100, we are incurring 180? What has caused this increase in the budgets of the company? So in such a case, when you go back and investigate, you now want to control the narrative that in future, we will be able to handle any issues that we might have, any inefficiencies that might have caused these costs to increase way above what we wanted to have during that particular period. So that process of just trying to manage the cost of the business through now preparation of budgets and comparing the actual to the budgeted figures, that is what we classify as budgetary control. So we can say that budgetary control is a method of managing costs through the preparation of budgets. Alternatively, we can say that budgetary control is the establishment of budgets relating to responsibilities of executives of a policy and the continuous comparison of the actual with the budgeted results, either to secure by individual action the objective of the policy or to provide a basis for revision. That you go back and just look at why is it that we were not able to achieve the cost that we wanted? Why is it that we're not able to achieve the sales revenue that the business intended to? Is there a problem regarding the efficiency in the organization? Is it a problem with the company, or is it a universal problem that all other firms in the industry are experiencing? So in that case, we'll say that you have a budgetary control system. So now that we know what a budgetary control system is, we can now go ahead and look at the objectives of budgeting. We usually have several objectives of budgeting. And the first objective as to why an organization can consider undertaking the budgeting process is to plan. When you're able to sit down and say that, for example, for a company, you want to produce 10,000 units, then it now allows you to plan ahead that for us to produce these 10,000 units, how much materials do we need? How much in terms of raw materials do we need? How much in terms of labor do we need? What kind of labor do we need? Do we need skilled labor or unskilled labor or semi-skilled labor? These people, how are we going to pay them? How much are we going to pay them? So you're able to quantify the cost for the labor. You're able to quantify the cost for materials. You're able also to look at any other expense that the business is going to incur. So you're able now to see the overheads, the raw materials, the labor needs of the business. And then now you check, do we have enough resources within the company to be able to finance these projects that we're looking at? Do we need to have, maybe do we need to get a loan? Do we need to raise additional finance from, let's say, the shareholders of the company? So in that case, now it just allows you to plan for the future. You're able to design a plan for which now you're going to achieve the future plans of the business. So in that case, we say that budgeting has an objective to just plan for the future position of an entity. That in this case, you're able to create detailed plans relating to production, relating to sales, raw material requirements, capital additions that you might need. And in that case, you will be able now to know how you will be able to achieve them in the future. The other thing is coordination. We have talked about coordination. And you're saying that budgeting plays a very important role in establishing coordination and maintaining as well coordination within the organization. And you talked about that case that we want to produce 10,000 units. So the budget has shown 10,000 units in the production budget, but these 10,000 units that are being produced, there are so many levels and so many departments that need to play a role in order for this to be a success. You're saying that the factory, the production department, they need to ensure that they produce these units in the factory. The procurement department needs to ensure that the raw materials that are required for this production is availed on time, so that now the production workers can use it to produce the units. The sales and marketing team, once these products has been produced, they need to be sold. The finance team, they need to ensure that they have the resources available within the funds are available to be able to now to be able to pay for those raw materials. So it allows for coordination within the organization. It is also a measurement of success. And when you say a measurement of success, it means that you're able to see whether the plans that had been created initially in the budget are actually achieved. You see that if you've created a budget, let's say we want to have sales revenue of 100,000 Kenya shillings or 1 million Kenya shillings, and you're actually able to achieve it, or you're even able to surpass that target, it means that you have done good, which now gives a sense of achievement and also accomplishment. So it means that you're able to measure the success by the achievement of the goals and targets that had been previously set. So if you had now looked at, or the budget was thinking that we want to reduce the total cost incurred in raw materials while still being able to produce a certain level of units, then it means that when you're able to achieve that cost level, you will have achieved the target, which means that now you can say that you have successfully achieved what was initially intended by the business. So in that case, our budget is very important, acts as an important tool for measuring the success of the business. Then it also acts as a tool for motivating the employees and also their managers, especially when you have achieved their objective. They're saying that it measures success. So if now you're able to achieve what you had initially budgeted for, and you know that indeed we have been able to achieve this, what it's going to do is that it gives you that sense of fulfillment, which now makes you think that we can be able to achieve even greater things in future. If we have been able to achieve this, which we thought we couldn't, then it means that we can even be able to achieve better goals, we can be able to achieve more goals again in the future. We can also try to improve our performance in the future. So it just acts as a motivation tool. Then we talked about this, it acts as a tool for communication. The top level management are able to now they're able to communicate their plans to the rest of the organization. The strategic goal says that we want to do what we want to increase sales. So now they come up with a sales budget. So this sales budget is passed down to the rest of the departments, which now tells different individuals at different levels that from the sales budget, it means that we need to produce, let's say, 100,000 units, meaning that the production department has to ensure that they produce the 10,000 units that are required. And you have, for example, the sales and marketing team, they know that these goods we need to market them. The finance team also needs that this is what we're supposed to do. So it acts as a way of just communicating information within the organization. And you'll find that once a budget has been created, a copy of this budget is usually distributed to all management levels. And then these management levels are the various managers are going to now provide detailed guidelines to their junior employees for them to be implemented by their employees within the firm. Then we have the other one is that, or the last objective is to control the activities of the firm, and control comes in whereby now you're able to compare what was laid down in the budget and what was actually achieved. Have we been able to achieve what was put in the budget? If not, then it means that there's something that needs to be done. You need to go back, cross-check. Why do we have these variances, especially the adverse variances? Is there a reason as to why the business is incurring these adverse variances? So if there is, then you go back and check, is this something that we can be able to change so that in future we do not end up having these adverse variances? Favorable variances are desirable, but when you have adverse variances, then it means that the organization has to just go back, cross-check, see why is it that the business was not able to achieve the planned performance, and is there something that can be done in order to ensure that in future the business is able to achieve their level of performance that was laid out in the initial budgets. So that is, or those are some of the main objectives of budgeting. The other thing that we need to look at is the role of the procurement management staff in budgeting. What role do the what role does the procurement department play in the budgeting process? So the first thing that the procurement department or the procurement management staff usually do is that they play a critical role in doing what? In sourcing the various resources that are required. You find that they play a very major role in sourcing, especially raw materials, the assets in the company. And you'll find that in most cases, the budgets, we have the cost budgets, we have the labor cost budget, we have the materials budget. So in this case, for the cost budgets, then it means that the kind of sourcing that the procurement department does is going to influence in total the total cost of the business incurred. So if now the procurement staff undertake the sourcing activity with seriousness, then it means that now the business will be able to find suitable suppliers who are going to offer high quality products, and then who are also going to offer affordable products, that the business will be able to get high quality products at the lowest or at the minimum cost possible, which means that at the end of the day, this one is going to help in controlling the cost of the business. You're saying that you're creating a budget. The role of this budget is to ensure that we have created a standardized cost for the business. So when you're creating a budget, the intention is that this is the amount of cost that the business wants to incur in a given period. So now if the procurement department takes the budget seriously, they are going to identify a suitable supplier whose prices are going to be almost in line with the budgets that have been created. So in order to now control the cost of the business, then it means that the management, the procurement department plays a critical role through ensuring that they source from the most affordable suppliers while still being able to get the highest quality products. In addition to that, the procurement department provides very important information regarding the prediction of costs. You say that you're creating a budget. This budget is something that you are estimating for the future. So you do not have the actual costs of these things. So you don't know what the price of sugar is going to be 1 week from now or 2 weeks from now, because again of issues relating to inflation. So what happens is, because the procurement staff have been working with the suppliers for quite some time, they've been able to see how prices change from time to time, meaning that they are best equipped to provide estimates of course. So in this case, they're thinking that the way things are going here in Kenya and the way inflation is taking things, then this product is likely to cost this amount. So as much as we bought these goods at 100 shillings per unit in the last month, there's a high chance that it is going to increase to 110. So when you're creating your budget, you don't use the current price of 100, use the current, the most probable price of 110. So that one now helps to just create a budget that is likely to reflect the kind of costs that the business will actually incur in the future, because again, they have first-hand information from the market, because they are always trading in the market, they're buying goods from the market, meaning that they are better placed in providing good or better estimates regarding the cost that the business is likely to incur. Then they also provide a detailed view of past spending of the business, because in this case, you will find that the organization is going to do what? The organization is going to require to create a budget. And again, you're saying that the budget is going to be what? The budget is going to be an estimate of the expected performance of the business in the future. So it is going to show what does the business expect with regard to these costs. So in that case, then the procurement department is likely to show that, yes, in the previous year, we had this budget, and this is the budget. And then in the current year, this is how much we were actually able to spend. So our budget, we had 100 shillings per unit, but now in the actual period, we were able to spend 110 shillings for each and every unit that we bought. So when you're creating now the current year's budget, we are not going to base our current year's budget based on the previous year's budget, but instead we are going to now use the current figures of the actual spending, which now is going to inform the preparation of the next year's budget. So do not rely so much on the previous year's budget, because again, due to cases of inflation here and there, you are going to find that what was budgeted for in the last year might not be the same amount of cost that the business is likely to incur in the current year. So instead of relying on previous budgets to develop this year's budgets, the procurement department is going to provide you with exact details of how much cost they've been able to incur in the current year. Then you adjust those current year's prices to now create the next year's budget. So they just help to provide a detailed view of the past spending, so that using those details, you can be able to prepare the next budget, which is going to be more accurate and more reflective of what is going on in the industry. Then, of course, lastly, it helps in accounting for volatility. And we're saying that it is important for the procurement department staff to be included in the budgeting process, because they help in planning for volatility in the supply chain. Volatility means that prices can change, prices can fluctuate here and there every single time. Especially in Kenya, we've seen that inflation has been a significant problem. So by working with now the procurement officers, the organization is able to now estimate how are the, for example, how are the supply chain costs likely to change or to fluctuate in the future period? How is it possible that the organization could have their material cost going up or the cost of certain assets going up? So that now, again, you can be able to flex your budget just to be able to incorporate the changes in the product, and also the changes in the product prices, because again, you're saying that they will keep on fluctuating from time to time. So those are some of the roles of the procurement department manager, and not procurement department manager, but procurement staff in the procurement staff in doing what in the budgeting process. So the next thing, we just look at the budgeting process, what it entails. So the budgeting process is the process of creating a budget, and it usually is undertaken in various phases. Of course, the first phase is the planning process. So you're going to have the initial planning stage, whereby you are thinking that we need to create a budget, we need to create maybe a sales budget, we need to create a production budget. We need to create a sales budget, we need to create a production budget, we need to do what? We need to create a sales budget, we need to create a production budget. We also need to maybe create a labor cost budget. So in this case, you gather data. Of course, you need to gather data relating to the budget, establish some objectives that you would want to achieve with regard to that particular budget. For example, you want to increase the sales revenue of the business. So how will you be able to increase the sales revenue? You'll be able to increase the sales revenue through now various activities. For example, if you're able to produce more of the product, then you will be able to sell more. And then also you need to do marketing for that. So it means that for your organization, there is a process. You don't just wake up and say that I am going to prepare the budget. There is a systematic process. So you need to plan ahead. You need to know what kind of budget are we preparing, what kind of data do we need to prepare this particular budget, establish your objectives, establish the targets. And then after you've established the targets, then you can be able to develop a budget. Show that, yes, our target is to produce 50,000 units. For these 50,000 units, this is the raw materials that we will be able to, this is the amount of raw materials that we'll require. This is the amount of labor that we will require. This is the amount of other overheads that will be required to produce these goods. And then once now you have developed a detailed budget, then you now compile this budget, you do some revisions where they are required, and then you pass that budget to be reviewed by the budget committee. So the budget committee is going to look at, yes, you're planning that, this is the cost. Do we even have the funds to facilitate this? Do we need to now maybe scale down? Let's not produce 50,000 units, let's produce 40,000 units. Maybe because the budget is too high for the company and you'll not be able to finance that. So once this one has passed through the budget committee, it could go back to be revised. Then afterwards, it's taken back to the budget committee for review, and then it is approved. And then now it is adopted by the rest of the organization. So you'll find that the budget process usually happens before the financial year begins. So you'll find that the budget process, especially for the large companies, usually begin about 4 to 6 months before the beginning of the financial year that you're intending to have, for example, the budget for the year 2023. So its development is going to start around October, November, October, September. The previous year, if now your financial year is going to begin in January, so that you can just be able to estimate in the next period what are the costs we are expecting in terms of materials, in terms of overheads, in terms of labor, so that now you're able to have ample time to now get all the detailed information, come up with a detailed budget, take it for budget for review by the budget committee before it is approved. And it's saying that most organizations usually set budgets, and always sometimes they undertake a variance analysis on a monthly basis. So you'll find that they create budgets for month on month, or for monthly or for quarterly. And these ones, they are going to be comparing the budgets with the actual. So for January, we had a budget of 100,000 Kenya shillings as sales revenue. Come January, were we able to get the sales revenue of 100,000 as desired? So in that case, they just undertake variance analysis. If there are any issues that need to be corrected before now they move to the next period, they will be done at an early stage. So you're saying that they usually start from the planning stage. So starting from the initial planning stage, the company goes through a series of stages to finally implement the budget. And the common processes include communication with then executive management. Then we have establishing of objectives and targets, developing a developed budget, compilation and revision of the budget model. Then you have budget committee review and approval. This one now, after it has been reviewed and approved, then it's saying that it is going now to be communicated to the rest of the organization. The next thing we look at is the various types of budgets that exist. And we have several types of budgets that exist, and we can categorize them or classify them into 3 main categories. We can classify these budgets by their function, by their flexibility, and also by the time. For us, the focus is going to be based on the functions. In this case, our focus will be on the functions, and based on the functions, we have several types of budgets. We have what we call the sales budgets, we have the production budget, the raw materials budget, the purchase budget, the labor budget. We have the production overhead budget, selling and distribution budget, administration cost budget, capital expenditure budget, and then the last one is the cash budget. When it comes to flexibility, there are 2 types of budget, fixed budgets and flexible budgets. And then with regard to time, we have what we call long-term budgets, short-term budgets, current and rolling budgets. So all these kinds of budgets are prepared, or the business can prepare again the type of budget that they feel is suitable for their company. So you'll find that the most common budgets, again, which you're going to look at, will be the sales budget, production budget, the purchase budget, the labor budget. Those are the ones that we will be looking at in this particular unit. So we shall start off with the first one, which is the sales budget. And as the term suggests, a sales budget is essentially a financial plan that helps to plan on how the company is going to utilize its resources in order to achieve a certain level of sales, that we have a plan to produce and sell a certain number of units. Let's say you want to sell 50,000 units. So, and these 50,000 units, maybe we'd like to sell them each at 100 shillings. So therefore, we want to have a sales revenue of 5 million Kenyan shillings. So in that case, that budget or that plan, that financial plan that has been quantified both in terms of quantitative amounts and also monetary amounts, that one we classify it as a sales budget. So we can say that a sales budget is a financial plan depicting how resources should be allocated in order to achieve forecasted sales. And the sales budget is an estimate of the total sales, which may be articulated in either financial or quantitative terms. When we say quantitative terms, this is now in terms of units, that in this case, we want to produce 20,000 units. In that case, we say that one is in quantitative terms. So if we want to sell these units in at 10 shillings each, then now we can convert this into monetary terms and say that we will be selling all of this at 10 shillings each. Therefore, our anticipated or forecasted sales will be equal to 200,000 Kenya shillings. So that is what we call a sales budget. And the purpose of sales budgeting is just to be able to plan for, as well as plan for and control the expenditure of resources that are necessary to achieve the desired sales objectives within an organization. That how can we be able to sell this number of units in order to achieve the level of production. So in that case, it is going to show, for example, how much money is required, how much money the business is going to make, how much material is required to achieve that level of sales, what is the labor cost that the business will be able to incur. That one, all those details are going to be included in a sales budget. So we look at the purpose of the sales budget. The purposes of the sales budget are almost similar to the purpose of any other budget. And we say that they usually act as a planning tool, a coordinating tool, and a controlling tool. We have already discussed these issues relating to planning, coordination, and controlling. How can a budget be used for planning? How can a budget be used for coordinating? How can a budget be used for controlling the activities of the firm? So I want us to look at an example of whereby now we have been given details and then we are expected to prepare a budget, a sales budget. So we have here a company. We told that company A is expecting to sell 10,000 cases in July, and then 20,000 cases in August and 30,000 cases in September of year 2. The selling price per case is equals to $30 each. And all sales are on account. The sales are collected 70% in the month of the sale and 30% in the month following the sale. So June sales are the June sales totaled $200,000, and bad debts are negligible and therefore can be ignored. So the question is asking us now to prepare a sales budget, and then also to prepare a schedule of expected cash collections from sales by month and in total for the third quarter. So we will start off with the sales budget. And in this case, the sales budget will be showing how many units does the business intend to sell in each and every month. So we'll have a budget for the July, we'll have a budget for August, and then we'll also have a budget for September. This budget is going to be inclusive of the quantitative amounts and also now the monetary amount. So we will create a budget which we call the sales budget. So we'll have a sales budget for each month that we have been provided with. So we have the month of July, we have August, we have September, then I will have the total for the quarter. So what we start off is with the budget itself. So for this particular product, we're told that the company has budgeted that it is going to sell 10,000 cases in July, 20,000 cases in August, and 30,000 cases in September. So what you're going to do is just show the budgeted sales figure. In this case, the company has budgeted for 10,000 in July, in August 20,000, and then in September, they have budgeted for a total of 30,000. So these sales, we want to now quantify it in terms of monetary terms. And you are told that the expectation is the company is going to sell each unit at a cost of $30 each. So therefore, if we sell 10,000 units in July and each unit is going for 30, then how much is the total sales revenue that the business is going to make? So we multiply the budgeted sales by the selling price per unit of 30. So in the month of July, it means that the total budgeted sales that the business is going to make will be equal to the $30 times the 10,000 units that the company is going to sell, which means that the expected total sales will be equal to 300,000. We do the same for August. We are expecting to sell 20,000 units. Each unit sold at 30, that should give us a total sales revenue of 600,000. And then in September, we are going to have 30,000 units sold at a total of $30 each. That should give us 900,000. So that is now for the total sales. The question is also asking us to show the month figure and also the total for this third quarter of the year. So in that case, we'll also have now a column for the total. So what will be the total budgeted sales for the third quarter of the year? So we'll sell 20,000 plus 10,000 plus 20,000 plus 30,000 for those 3 months, meaning that the total sales is going to be equal to 60,000 units. These 60,000 units all sold at a selling price per unit of $30. That should give us a total of 1.8. So that one should give us a total of 1.8 million for, 1.8 million for that particular period. So now that we have 1.8 million, this is now the total sales for the entire quarter. And that is how we would be expected to prepare that sales budget. But in this case, we are only looking at how many units the business has budgeted to produce and how many units, how much money they are likely to obtain from the sale of those units. So that is the first part of the question. The second part of the question is asking us to prepare a schedule of expected cash collections from sales. So in this case, now you are looking at if we were to sell this number of units, there are some cases whereby the business is not going to expect to receive all these goods or the cash for that particular, for those particular products in the same month they have sold, because in this case, they have sold their goods on credit. So you're told that 70% is going to be received on the same month, and then the other 30% will be received 1 month after the sale. And this is the detail we have been given here, that the sales are collected 70% in the month of sale and 30% in the month following the sale. Meaning that for July we have what? For July, we have that the business is going to sell 10,000 cases. And for these 10,000 cases, we've seen that each unit is going to be sold at 30, meaning that the total amount the business is getting is 300,000 for this is the revenue for for July. And as much as this is how much the business is selling in July, there is only 70%. So 70%, which is 70% of 300,000, which is equal to 210,000, will be received in the month of July. And then the other 30% will be received 1 month later. So that one should be 30% of 300,000. That should be 90,000. 90,000 is going to be received in the month of August, not this one is going to be received in the month of August. So now we will be creating now the forecasted sales or the expected cash collections. There's also a detail here we were given about the sales for June, that June's total sales were equal to 200,000. So it means that for this total sales were made in June, 70% were received, the cash was received in June. And then now there's this 30% of the cash that is now going to be received in the month of July. So it means that July we are going to have 30% of 200,000, that should give us 60,000. So July will have 60,000, which is now the sale, the 30% of the sale in June. And then we'll also have now for the 70% in July, which we've obtained as 231,000. So we'll be doing that for each and every month to see how much cash flows do we expect from that sale. So we'll start off with the expectations for the month of July. We've said that for July, we'll receive 30% of what was sold in June, which we have obtained as 60,000. And then we'll also have now the July sales, 70% of what will be sold in July will be received in the same month. So in this case, 70% of the 300,000 for July will be received in July, that is 210,000. And then the other 30% of what is sold in July is going to be received in August, which you have obtained as 90,000. Then we can get the total for July. So we'll have 60,000 from the June sales, and then 210,000 from the 70% in July sales, meaning that in total, for July, we are going to have total cash collections of 270,000. Then we can move on to August. For August now, we say that we will receive what was sold, 30% of what was sold in July, and that is equivalent to 90,000. And then 70% of what was sold in August. In August, we're selling 600,000. So 600,000 times 70%, that should give us 420,000. 30% of what is sold in August is going to be received in September. And in this case, so September, 30% of 600,000, that is going to be received in September of 180,000. So we can now finish off with August and say that for August, the total amount of cash collections will be the 90,000 plus 420,000. So total cash collection will be equal to 510. Then the final month is September. So in September, we are receiving 30% of what was sold in the previous month of August. We've obtained that one as 180. And then now 70% of what is sold in the month of September, which we obtained as 900,000. So 900,000 and 70%, that one should give us 630. So now we have 630 plus 180, that should give us 810,000. So 810,000 will be the total amount of cash to be received in the month of September. So therefore, we can now get the totals for the quarter. So what we're just going to be adding is the figures for each month. So we'll have here the 60,000 from the June sales, and then now to 10 plus 90,000, that should give us July sales. What is going to be received? Cash collections will be to 10 plus 90. That should give us 300,000. Then we go to these ones in August. We have for August, we have a total of 420 plus 180. That one to give us 600,000. And then now in September, we're going to receive 30%. We're going to receive 70%, sorry, of what was sold in September, which is 630. So the total sales for that quarter, we add it by 60, 300, 600,000, 630, that should give us 1.59 million. Or alternatively, we can add the cash collections for July, August, and September of 210,500 and 270,510,000, and then plus 810,000. That should give us a total of 1.59 million. So that is how we can prepare the sales budget as well as the expected cash flows from these sales figures. So that is the sales budget, and you're seeing that essentially it is just showing us how much the business expects to sell in a given period, and it is going to show us in terms of quantity as well as in terms of quantity as well as in terms of the monetary value. And then also using that figure, we can also be able to estimate how much cash flows the business expects from, or how much cash collections the business expects to receive from the sales that they have made in the previous months. So that is the sales budget. The other kind of budget that we need to look at is the production budget. And again, as the name suggests, the name is suggesting that we are looking at creating a budget for production, for how many units the business needs to produce in a given period of time. So the production budget is going to have details about the number of units of finished goods that must be produced by the business in a given period. And you're likely to find that the production budget, what is included in the production budget, is likely to be influenced with the sales budget. So we've just looked at the sales budget, that in the sales budget, the company's intention is to sell 10,000 units in July, 20,000 units in August, and then 30,000 units in September. So it means that what you're going to produce is going to be influenced by what we intend to sell. So that is what is going to now influence the production budget, that what you're likely to produce is going to be influenced by the expected sales that the business makes. It can't be that we're expecting to sell 100,000 units and then we are only producing 20,000 units, and maybe we did not have anything left in the opening inventory or the closing inventory for the previous year. So it means that we will have to now look at what is the intention, what does the company need to sell, or what is it anticipating to sell. And then based on that, we can be able to know exactly how many units the business is going to produce. So what you have to notice that for the organization, sometimes you don't just produce exactly the number of units that you intend to sell. So it can't be that we want to sell 1,000 units in a given 100,000 units in a given period. That doesn't mean that we will exactly produce 100,000 units. We need to do some calculations and some adjustments in order to determine how many units the business should produce in a given period. And how many units the business produces in a given period is going to be determined with how many units did the business have in opening inventory. Are there any units that were left in the companies at the beginning of the period? Is there any units that we started out with at the beginning of the period? And also, do we want to have any other units in closing inventory? So let's say the business already had 100, let's say it had 1,000, or let's say 40,000 units in their inventory at the beginning of the period, that their opening inventory was 40,000 units. And then this business wants to be left with 60,000 units in closing inventory, and they want to sell 100,000 units. So how many units should they produce in this given period, given that they want to sell 100,000 units and they want to sell 100,000 units, they already have 40,000 units, and they want to be left with a closing inventory of 60,000 units. So in this case, to know how many units the business should produce, it will be equal to what the company desires to have in their closing inventory. So they want to have 60,000 units in the closing inventory, plus what do they want to sell during this period. So in this case, that will be equal to 160,000. That if we were to cater for what we want to sell and what we want to be left with, then this is equals to 160 units. But we already have 40,000 units. So therefore, we already have 40,000 units in opening inventory. So therefore, we only need to produce 120,000 extra units. So that out of the 120,000 extra units, we can sell off 100,000. And also we can be left with 60,000 units, given that we already had 40,000 units in the business. So in this case, we can simplify all this, what I'm talking about, by now looking at a very simple formula for computing how much the business needs to produce in a given period in the factory. So the units to be produced in the given or in a business in a given period should be the desired closing stock of finished goods plus the budgeted sales minus the opening stock or the beginning stock of finished goods that you already had 40,000 units. So in this case, this is your opening inventory. And then you wanted to sell 100,000 units and you wanted to be left with 60,000 units. So therefore, we're saying that it will be equal to what you want to be left with, the closing stock of 60,000 plus what you want to sell, the budgeted sales, minus what you already have. So therefore, to know how many units should be produced in the factory to meet all these needs is that you need to produce 120,000 units. That is how now we know how many units the business should produce in a given during a given period. So let's look at the preparation of a budget, taking into consideration that sometimes the business has some opening stock. Sometimes they want to sell a certain number of units and also they want to be left with a certain level of production at the or a certain level of finished goods at the end of the period so that they can start off with some opening inventory in the beginning of the next period. So we have been given here details about an organization. This organization is called Bell Telecom. So Bell Telecom has budgeted sales of its innovative mobile phone for the next 4 months. We've been given details about July. They're budgeting to sell 30,000 units. August, they're budgeting to sell 45,000 units. September, they're budgeting to sell 60,000 units. And then lastly, October, they're budgeting to sell 50,000 units. In general, we're told that the company is now in the process of preparing a production budget for the third quarter. The ending inventory level must be equal to 10% of the next month's sales. So what this means is that what should be left in July as the closing inventory should be 10% of what is to be sold in the next month, which is August. So it means that the closing inventory for July will be 10% of 45,000, which is going to give us 4,500, meaning that when we close this month of July, we should have a closing stock or a closing inventory of the 4,500. So we will put that into consideration. So yes, so we have here that what are we required to do? So to calculate the ending inventory as of June 30th, and then also prepare a production budget for the third quarter, showing the number of units to be produced each month and the total for the quarter. So the first thing is to calculate the ending inventory as of June 30th. So June 30th, we've not been given here details about June. We've been given details from July, but we can be able to estimate the details from June, the closing inventory for June, by looking at the details which you've been given here regarding the ending inventory, because they're talking about the ending inventory. Ending inventory is the same as closing inventory. So given that the expectation is that every single month when you close, the closing inventory or the ending inventory must be 10% of the next month sales. So June, the next month is July. So it means that in June, then we'll take 10%. 10% is the same as 0.1. So 10% of what is expected to be sold in the next month. And the next month is July. So meaning that in June, 10% of 30,000. So it means that the closing inventory for June would be equal to 3,000. So if the closing inventory for June is 3,000, we finished June with 3,000 units, meaning that when we open July, then we're going to start with an opening inventory of the 3,000 units. So let's look at now the preparation of the production budget for the third quarter, showing the number of units to be produced each month and also the total for the quarter. So we've already computed the ending inventory for June. We say that it will be 10% of what is to be sold in July, which we've obtained as 3,000 units. So now we come to the preparation of the budgets, and we'll start off with the budget for July. So we've said that how many units should be produced will be equal to the total closing inventory that you would desire, plus the budgeted sales or the desired sales, and then minus the opening inventory, what you already had at the beginning of that particular month. So in this case, we need to compute the closing inventory for the month of July. We have been given the budgeted sales, and then we have the opening inventory for that month of July. So in this case, what do we do? The budgeted sales for this particular month, the budgeted sales for July, that one we've already been given, is 30,000 units. So in this case, our budgeted sales, we say 30,000 units. And then now the closing inventory for the month of July, we say that it should be equal to 10% of the budgeted sales in the next month. So the next month is August. So 10% of 45,000, we say that this one is going to be 4,500. So now we have our closing inventory, or our ending inventory is supposed to be 4,500. The budgeted sales is 30,000. So we come here and say 4,500 plus 30,000 minus the opening inventory, which we obtained as 3,000. So that one should give us the total number of units that are required to be produced in the month of July. So 4,500 plus 30,000 minus 3,000, that should give us 31,500. So it means that in the month of July, the business should produce 31,500 units of that particular product. Then we go to the next month. The next month is August. So when we start August, we are going to still use the same idea, that it will be equal to your closing inventory plus the budgeted sales, and then minus the opening inventory. So the budgeted sales for August is 45,000, and their closing inventory, you're saying that it is equal to 10% of what is expected to be sold in the next month, which is now 60,000 to be sold in September. So 10% of 60,000, that should give us a total of 6,000 units. So our closing inventory should be equal to 6,000. So therefore, the number of units we need to produce will be 6,000 plus now the 45,000 for the ones we're intending to sell, minus our opening inventory. So what we closed off with in July, the ending inventory in July, is what we're going to start off with in January. In August. So in this case, now we'll have here minus 4,500. So that one should give us a total of 46,500 as the required production. So now we close off with 6,000 as closing inventory in August. Then the closing inventory in August is going to be the opening inventory in September. So in this case, again, we do the same. So now we check for September, how many or how much does the business intend to have as closing inventory? So for September, we want to produce 60,000 units, and the closing inventory should be 10% of what is to be sold in the month of October. And in the month of October, the company's intention is to sell 50,000 units. So we're supposed to close off with 5,000 units. So therefore, we come here and show the amount that the business wants to sell in September is 60,000 plus the ending inventory of 5,000 minus what they already have in closing inventory from what was there at the end of August. So in this case, we start off with 6,000. So we'll have 60,000 and then plus now the 5,000 minus 6,000. That should give us a total of 59,000. So these budgets, as you can see, they are very logical, that they're just able to show us how the business is expected to plan ahead for their activities. And using this now, they can be able to know how much resources will be required in terms of materials, in terms of labor, and in terms of overheads. The other thing the question was asking us is to compute the total for each quarter. That is for the quarter between July and August. So we add the total budgeted sales, should be 30,000 plus 45,000 plus 60,000. That should give us 135,000. The ending inventory for the third quarter now, for this particular quarter, the third quarter, the ending inventory is going to be what is left after the end of the quarter, which is September. So in this case, we're going to have 5,000. And then now the total inventory needs, in this case, we just add what was there in the given month. So we have at the beginning, we had the total needs for July was 34,000, this one 51,000 plus 65,000 to give us total needs to be equal to 140,000. And then we have the opening inventories that we're starting out with all through the periods. So in this case, we are going to consider the opening inventory for the quarter, because now we only need one opening inventory. And for this particular quarter, we were starting in July. So therefore, the opening inventory was equal to 3,000. So now we do the totals. This one should be equal to 137. So we can do 135,000 minus plus 5,000. The total needs will be equal to 140,000 for the quarter minus what we started with in the beginning of the quarter, which is 3,000. So the total needs will be equal to 137,000. So this one figure can also be obtained by adding up the required production for the given month. So we have 31,500 plus 46,500 plus 59,000. That should still give us the 137,000. So now this is the third quarter. So when we start the last quarter of the year, that will be in October. And in October, the expected sales will be 50,000, but you'll be starting off with an opening inventory of 5,000. So that is how, again, a business can just be able to prepare their production budgets. And you're saying that the production budgets is likely to be based, or it is going to be based on the projected sales of the business. You can only be able to know how many units you need to produce by knowing how many units you want to sell, how many units you want to be left with at the end of the period, and then also what? And then also how many units you already have in your business. So we'll be using that formula there. For the production or number of units to produce, to just help us know exactly how many units the business needs to be showing in their budget for production. The other type of budget we have is the purchases budget. And the purchases budget, again, just as the name suggests, is that it shows the requirements for the business of how many units need to be produced, and therefore just helps the business to get the resources available, resources enough to produce those goods. So to buy those goods, sorry. So if you want to produce, if you want to buy, let's say 10,000 units of a product, and you're budgeting that each unit is going to go for 50, then it means that now the total amount you're budgeting for will be equal to 500,000. So that now is what is going to be included in the purchases budget. We're saying that the purchases budget just shows how many units the business intends to produce in terms especially of materials, direct materials, indirect materials, so that they can be able to show as much as they're showing in terms of units, but also quantify it in terms of monetary terms, so that they can be able to establish exactly how much they would need in order to acquire those items. So what is the main purpose of creating a purchases budget? You'll find that purchases budget is important because it designates cash requirements in respect of purchase to be made during the budget period. That we were saying that you want to produce, what? You wanted to produce 100,000 units. For this 100,000 units, each unit will spend 20 shillings. So therefore, you'll require a total of 200,000. So that is the cash requirement that you would require to have those resources within the business. The other one is that it facilitates the purchase department to plan its operations in time, respect of purchases, so that long-term forward contract may be organized. That in this case, you have the budget for the entire year. So you will know that in the month of, let's say, January, this is how many units you're going to require. In the month of February, again, this is how many units you're going to require. In the month of March all the way to December, this is how much you're going to require. So if you cumulatively see that maybe you are going to buy 1.2 million units from the company, it means that you can be able to negotiate with this supplier and tell them that we don't only want these 100,000 units, but cumulatively we will be buying from you for the entire year over 1.2 million units. This one we are buying in wholesale, and therefore we need you to give us a discount, or what you usually call the bulk discounts, that because you're buying it in large amounts, then we are liable for a discount. It is actually suitable for the company to be given a discount for buying those number of units. But if you're only looking at just buying moja moja, you wouldn't know how much exactly you require for the entire year. So it also becomes a little bit difficult for you to now just negotiate for suitable prices with the supplier when you are now getting into a contract with the supplier. Then we have the other type of budget, which we call the raw materials budget. So the raw materials budget is a type of purchases budget. And in this case, it is looking at now the raw materials that the business is going to require. That is raw materials and any other component that the business is going to require in the production process. We've just looked at the production budget. You want to produce 10,000 units of a product. So this 10,000 units of a product, how much in terms of raw materials is it going to require? So in this case, now you look at the production budget for this 10,000 units. This is the amount of raw materials that we will require to purchase, so that now we can be able to plan ahead again. How much do we need to spend in terms of raw materials for these products that we are intending to buy and also sell them, produce them, and then sell them off to the clients? So you can say that the raw materials budget, this budget shows the estimated quantity of raw materials and components needed for production demanded by the production budget. And the raw materials budget usually serves various purposes. The first one is that it usually supports the purchasing department in scheduling the purchases. You can be able to know how many units the business requires, how many units of raw materials the business requires in order now to produce those goods. So then they know that this is the number of units that we need to buy in terms of raw materials. And the raw materials to be purchased will be determined again by the formula that we just looked at, that it will be how many units do we want to have in the closing inventory at the end of the period, plus now the raw materials to be used in production, and then minus the opening raw materials. So if you have any raw materials that were left over from the period, the last period, you're going to deduct. So it will be closing inventory plus the raw materials to be used in the production during that period, minus what you already had at the end of the period. So it just helps to establish exactly how much raw materials the business needs to purchase at a given point in time. The other important purpose of having the raw materials budget is that it shows the requirement of raw materials, or the requirement of raw materials is decided on the basis of production budget. And in this case, you can be able to know how much raw materials is needed based on the production budget. This one is actually a continuation of this point here. Then it also provides data for raw material control. If you have a budget and you're saying that it is common for businesses to have standard levels of efficiency, so maybe the company has established that if the employees are efficient and everything is done efficiently, 1 unit of a product should be able maybe to use 20 grams of this raw material. So if you find that in a given period, they're using maybe 30 grams for every unit, it means that there's a lot of wastage, which means that the business will have to go back and cross-check. Why is it that we're incurring so much in terms of raw material costs? Why are you having this variance of 10 grams more than what was initially intended? So they go back, cross-check, and just try to see why is it that the efficiency level is not up to standard. And that acts as a way of controlling the activities. You look at the variances, and then you go back and investigate with the intention of trying to resolve any issues that the business might have at a given point in time. And then the last one is that having the raw materials budget helps in deciding the terms and conditions of purchases, like credit purchases, cash purchases, and also payment periods. Just the same way the production, the purchases budget, you're saying that if you know exactly how much raw materials you want to, how much you need for the entire period, you can be able to negotiate the prices that you can get from your supplier. You can be able to negotiate for discounts here and there. Give me a second, kindly. Sorry about that. So yeah, we're seeing that it helps in just negotiating for some terms and conditions of the purchases. So if, for example, it's a credit purchase, you can be able to negotiate with the supplier on how much discount they can grant you, how much is the credit period, after how long should you be able to pay. If you're paying the cash, how much is the cash discount again that they should grant you. So that is what we classify as the classify as the raw materials budget. So for the raw materials budget, we have two types of raw materials as we had looked at when we started. We have what we call direct materials, and then we have the indirect materials. The direct materials, we say that these are materials that can be able to be traced to the final unit of production. So you're likely to have a budget for the direct materials, and then the indirect materials. These ones, they are usually included in what we call the production overheads budget. So the direct, indirect materials, indirect labor, these ones you're likely to find them in the production overheads budget. But for the direct materials, so that these ones are the ones that you can be able to trace them to the final unit of the product, and they also make up part of the final product. So in that case, therefore, let's look at now the direct materials budget. And the direct materials budget basically determines the quantity of direct materials that must be purchased in each period in order to meet the anticipated production needs. And you say that this one is going to be influenced by what is included in the production budgets. So this budget is saying that it is going to inform the business on how many raw materials need to be purchased in order to meet the production needs, and also in order to provide for adequate levels of direct material inventories, that at the end of the day, how many units do we want to have in closing inventory, and how many units do we have in opening inventory. So using now that production budget, you can see how much is in opening inventory in each period, how much is in closing inventory, how much you need to use for production. So therefore, you can be able to know how many units should the business buy at a given point in time. So let's look at an example whereby now we need to do it. We need to prepare a production budget, not a production, but a materials budget, and a direct materials budget at that. So we have here a company. The company is called Texas Products, and Texas Products has developed a very powerful electronic calculator. Each calculator requires 3 small chips that cost $2 each and are purchased from an overseas suppliers. Texas Products has prepared a production budget for the calculator by quarter for year 2 and for the first quarter of year 3 as follows. So we have for the the last quarter of year 2, this is the budget. Then we have the so it has produced for all the quarters actually of year 2 and the first quarter of year 3. So in the first quarter of year 2, the budgeted productions in calculators are 60,000, the second quarter 90, the third quarter 150,000, the fourth quarter 100,000, and then in year 3 the first quarter is equal to how much? Is equal to 80,000. So the other thing is that we have been given some additional details here, and the additional details is that the inventory of the chips at the end of a quarter must be equal to 20% of the following quarters production needs. There will be 36,000 chips on hand to start the first quarter of year 2. So the question is asking us to prepare a direct materials budget for the chips by quarter and in total for year 2, including the dollar amount of purchases for each quarter and for the year in total. So therefore, we use again the same concepts, the same ideas as we had in the what? As we had in the in the other types of budgets. So we're just pushing forward the details for each year, for each quarter, sorry, based on the amount of budgeted production and also the opening and closing inventory that is existent at a particular point in time. So we shall start off with the first quarter of the year. So remember, we are producing a calculator, and each calculator requires 3 small chips, and each chip costs $6 each. So let's first look at how many units or how many chips are required for this first quarter, which requires 60,000 calculators to be produced. Each calculator requires 3 small chips, and each chip costs $2 each. So we come here and look at the first quarter. So we will start with the details about the calculators to be produced. In the first quarter, we are producing 60,000 calculators, and each calculator requires how many chips? 3 chips. So therefore, how many chips do we require to produce these 60,000 calculators? It means that it will be 60,000 times 3. That should give us 180,000 chips that will be required. So now that we require 180,000 chips, we also need to consider, because the issue is on how many chips should we buy and how much is it going to cost us in order to produce those chips. So we have been given some details here. We've been told that the inventory of the chips at the end of each quarter must be equal to 20% of the following quarter's needs. So we have the following quarter, we are going to require 90,000 calculators. And for this 90,000 calculators, we have each calculator is going to require 3 chips. So 90,000 times that should give us 270,000 chips. So the closing inventory for the first year should be 20% of these chips in the second year, the second quarter. So 20% of 270,000, that should give us 54,000 chips, meaning that when we close the first quarter, we will require 54,000 chips, which is 20% of the requirement of the chips in the second year. So we have said that what needs to be bought will be equal to the closing inventory that we desire, plus what needs to be produced, and then minus what you had at the beginning of the period, minus the opening inventory. So we want to be left with 54,000 chips, and then we will use 180,000 chips, and we already have, we're told something about 36,000 chips are on hand at the beginning of the first quarter of year 2. So that will be the opening inventory for the first quarter. So in that case, we have opening inventory was equals to 36,000, meaning that we're going to require a total of 198,000 chips to be bought during this period. So now that we need to buy 198,000 chips, each chip is going for $2 each, meaning that the total purchase cost will be equal to $396,000. So that is now for the first quarter. We go ahead and do the second quarter, the third quarter, and the fourth quarter using the same concept. So what we are left with at the closing, the closing number of chips in the first quarter is what we're going to start off with in the second quarter. So when we start the second quarter, we were told that the company is going to require 90,000 to produce 90,000 units. This 90,000 units, each unit requires 3 chips. We can do the same. The third quarter is going to require 150,000 units. Each unit requires 3 chips. So they're going to produce 450,000 chips. So they need 450,000 chips for that production. And then the fourth quarter, we have 100,000 units need, and each unit requires 3 chips. So they require 300 units. And then of course, this one we'll say it will be 270,000 chips. So now we have for the second year, so we need to know the closing inventory, and you're saying that the closing inventory will be 20% of the requirement for the next year. So the next year, the requirement for production will be 450,000. So 20% of 450,000, that one should give us 90,000. So therefore, we're going to require a closing inventory of 90,000 chips, plus now what needs to be actually produced during this period of 270,000 minus the opening inventory. The opening inventory, we had 54,000. That was the closing inventory for the previous year. Here minus 54,000. That one should give us 306,000, and each chip is going for $2 each. Therefore, the total purchase cost for the business for these materials will be equal to the 612,000. So we do the same for each and every quarter. The concept is the same. And then now we can do the final totals for the year. So in this case, the totals for the year, we have calculators produced during that particular year. We have actually, this one is now for the third year, yes. So for the third year, we have how many calculators? We were told that the calculators to be produced will be equal to 80,000. They'll require 3, that should give us to 40. And then the ending, in this case, the ending inventory. So the ending inventory in this case, we have not been provided for the last year. So we are going to use the ending inventory for the fourth year. So in this case, we'll assume an ending inventory of 48,000. Then we have, so now we have 240,000 plus now the ending inventory, saying that we're going to use the same as the fourth year. So in this case, we will require a total needs, or the total needs for the chips will be equal to what? These ones have been jumbled up. We have jumbled these ones up. So in this case, will be 240,000 plus 48,000. That one should have been 288,000. That is for the last quarter, the first quarter of year 3. That one should have been 248,000 for that quarter. 288,000 for that quarter. So they have jumbled these ones up. And then we have the total opening balance. The opening balance should have been the closing balance for the previous period. So for the year, the first quarter of the year, so in that case would have been the closing balance for the previous period, and the closing balance for the previous period was a total of how much? The closing balance was a total of should have been 48,000. So this one they have really jumbled up. This one should have been here, there, 48,000. So now 248,000 minus 48,000, that should give us a total of 200,000, and then 200,000 times 2, that one should give us 400,000. So what was actually asked was just this part, but instead it was the total for the given period. So in this case, we've not been given the total, but we can be able to calculate the total for this quarter. So the total for the quarter will be the total number of units to be produced in that quarter. That is the first quarter, the second quarter, the third quarter, and the fourth quarter. So we'll have 60,000 plus 90,000. How much should that be? So we have 60,000 plus 90,000 plus 150,000, and then plus 100,000. that should give us the total number of units to be produced should be equal to 400,000 units. These 400,000 units each produced at a cost of $3 per unit. So that means that the total needs will be equal to 1.2 million. And then now the closing figure, I see why they were having this here 48. So now the closing figure, what we want to be left off with at the end of the period is the figure we obtained of the ending figure for the fourth year. So in this case, for the fourth year, we're supposed to be left with a total of 48,000 units. And that will give us a total of 1,248,000. Then we have our opening figure. That is what we started off, the number of units that we started off at the beginning of the period, which is equal to 36,000. So we'll be left with 1,212,000 as the total number of units for that period. And then each chip is going to go at $2, which means that the total cost for the period will be equal to 2,424,000, which is now going to be equal to the same as this, plus this, plus this, and plus this. So these figures here, they jumbled them a little bit, but the total figures should be these ones here that we have just computed. So that is how you will be expected to prepare what we call the budget for what? Is it the production budget? Not the production budget, but the direct materials budget, that how much will the business be expected to spend in terms of direct materials. Closely related to the direct materials is the direct labor budget. And the direct labor budget now looks at the total amount or the total number of the total amount of money that the business is going to pay to the employees for the work done. That you find that in most cases for productions, as much as you can automate your production activity, there is always that aspect of the workers in the factory using this machine and using the machine to produce goods. So you'll find that now you have to pay the employees for the units that they produce. So in this case, you'll need to prepare a budget, the budget for the labor that is going to be used in producing those goods and services in order to achieve the budget levels that you are desiring. So the budget, we say we have again direct labor and we have the indirect labor. The direct labor is going to have its direct labor budget. For the indirect labor, this one we are going to include it as part of the overhead budget. So in this case, overhead, we say that these are the other expenses that the business is going to incur. So those details will be included in the overheads budget. So let's look at an example whereby, again, we are expected to prepare the direct labor budget. We're told that we have a production department. The production department of company B has again forecasted, has the following forecast of units to be produced by quarter for the upcoming fiscal year. And you have the first quarter, the second quarter, the third quarter, and the fourth quarter. And in this case, the units produced, they want to produce 10,000 units, 8,000, 8,500, and finally 9,000 units. We're told that each unit requires 0.6 direct labor hours and at a cost of $15 per direct labor hour. The workforce can be adjusted each quarter for the expected production level. So the requirement is to prepare the company's direct labor budget for the next year. So you find that the direct labor budget is actually straightforward because For labor, you can't have opening inventory and closing inventory. So what you're going to have is exactly what you're going to spend is exactly what you have budgeted for. We don't expect any opening inventory. We don't expect any closing inventory when it comes to the labor. So therefore, we can prepare the budgets. In this case, we prepare the budgets for the first quarter, the second quarter, and the third quarter. So let's start off with the first quarter. In the first quarter, we start off with the, of course, the number of units. In this case, the intention is to produce 10,000 units in the first quarter. And each unit is saying that it is going to require $0.6. We want to know the total cost. So in order to know how much you're going to spend, then you need to know how many hours in total. So we want to produce 10,000 units. Each unit is going to require 0.6 hours. So therefore, we're going to spend a total of 6,000 hours to produce these units. And each hour, you're paying $15. Therefore, how much will be the total that the business pays for that particular period in terms of direct labor? So in that case, it will be equal to the 6,000 multiplied by 15 to give us 90,000. We do the same for the second quarter, the third quarter, and the fourth quarter. So 8,000 units. And each unit produced within 0.6 hours. So therefore, you're going to spend a total of 4,800 hours. And for each hour, you pay $15. So 4,800 times 15 to give us the 72,000. You go to the next one, 8,500 units to be produced, each within 0.6 hours to give us a total of 5,100 multiplied by 15, that to give us 76,500. Then we have now the last one is 9,000 units. Each unit takes 0.6 hours. So total hours you will spend is 5,400 hours. And in this case, multiplied by 15, that should give us 81,000. So that one now shows us again the total amount of money that the company is going to incur in order to produce those units in a given period. So that is what we classify as a what? That is what we classify as a direct labor budget. And you're saying that this one is straightforward because again, the business, we don't have opening and closing inventory of labor. Then we have the other type of budget, which we call the departmental budget. The departmental budget refers to the budget that the business prepares for the entire department, how much do we expect to pay? So this, how much income first are we expecting to receive in the department? How much expenses are we expected to pay, for example, in terms of utility bills, in terms of labor, in terms of salaries, not labor, in terms of salaries, in terms of electricity, those insurance, those kinds of things. So a budget that just shows the departmental level financial plan to spell out the total amount of spending that the department intends to make in a given year. That one is what we call a departmental budget. So we have here an example of a departmental budget. The departmental budget is going to show each type of income and each type of expense that the business expects to have. So any amounts that you're expected to receive in the department may be in the form of interest income, dividends that the business will be expecting. Those ones are going to include them there. Any expenses, you're going to deduct them so that you can be able to show in total how much is the expected net balance from each department in terms of incomes and expenses in each and every of the years. Then we have the next type of budget, which we call the master budget. And the master budget now is a budget that includes almost all the details that we have just looked at. That it includes a number of separate but interdependent budgets that formally reports the company's sales, the company's productions, and the company's financial goals. We say that at the end of the day, these budgets are interconnected. So the sales budget is going to influence the production budget. The production budget is going to influence the purchases budget. It is also going to influence the raw materials budget. It's also going to influence the labor budget. So all these ones cumulatively now, if you want to prepare one comprehensive budget for the organization, then you will include it in a master budget, but you're not expected to prepare the master budget. So in this case, you're saying that the master budget, the starting point is the sales budget. If you want to prepare the master budget, because the sales budget is what is going to influence everything else. It is going to influence how many units you produce, going to influence how many units, how many raw materials you're going to buy, how much you're going to spend in terms of labor and things like that. So the starting point for the master budget will be the sales budget. And then the ending point for the master budget will be the budgeted financial statements that will be expected now to show how much each and every of these items are going to affect the overall performance of the business. So you'll prepare the income statement or the statement of profit or loss, whereby now you're expected to show how much would you now spend in terms, or how much you're going to make in terms of sales revenue, how much will be the cost of sales, how much will be the gross profit, and then you deduct the expenses in order to get now the expected profit. So all these details are going to gather information from all the other budgets, but I'm saying that you're not expected to prepare the master budget at this level. Then we have another budget that businesses usually prepare, and that is budget for consultancy services. That for the organization, sometimes you don't just buy raw materials. What you do is sometimes you do consultations with other entities, and as you're doing this consultation with other entities, sometimes they're going to charge you a fee, they're going to charge you a certain amount of money based on the number of hours that these consultants are going to work with the business. So for example, you're working with a lawyer. This one is a consultant to the business. They're providing legal advice. So they're going to charge you based on the amount of work they do and the number of hours that they spend. So you also need now just to create a budget that we're going to require this amount of, we're going to require these consultants. And for these consultants, this is how much they are likely to charge us. So you now have to show all the payments that you expect to make to each and every of these consultants, all the expenses relating to the services that you are going to acquire from this consultant, you are going to include that. So this is going to include details about any fees that they are going to charge you based on the number of hours. If you're paying for maybe their travels, maybe movement from one place to another, if you're paying for their transportation cost, again, you're going to include that. If you're paying them per diem, that is an allowance every single day for the amount of work that they do. All these costs, all these expenses are going to be included in the budget, and then it will be billed based on the project that these ones are undertaking. So you'll find that these consultancy services, you're likely to find them, especially when you are having contracts, when you have contracts with your suppliers, when you have contracts and tenders that you're providing, and now you need consultants, maybe an architect here, you need an engineer there that is coming once in a while, then you are going to use that, or you're going to now prepare a budget for the consultancy services. Budget for consultancy services also go almost hand in hand with what we call the budget for works or the BOQs. The BOQs are also known as the bill of quantities. And this is essentially a document that is prepared by the cost consultant or the company's quantity surveyor. And this one just provides details about a given project. So let's say the organization has a tender, you have won a tender, maybe to build a road or to build a road, or a bridge somewhere. So for this particular bridge or for this particular road, you have to know exactly before you are even able to decide, how many, how much you should charge your client. You need to be able to decide again, how you need to be able to know exactly how much you will produce or how much you're going to spend to have that project ready. So you're going to have your quantity surveyor just do an analysis of the total cost that you're going to incur during that project. How much labor will you need? How much labor will you need? How much expenses are you going to incur? How much materials will you need? So that by the time you're now quoting a price to the client, you know exactly how much this tender is going to cost you. So that budget now that just shows the total amount you expect to incur in a given period when you have a project or you have a tender. That one, we call it the budget for works or the BOQs. So that brings us to the end of this particular chapter on budgets. And what you can see is that for these budgets, they are very straightforward, that these budgets are very straightforward, that you're going to be given the details that you need to be able now to prepare a budget. And I have a question that I want you to try out. This is a question that was tested in April 2022, question number 4C. And this one now just requires us to prepare a production budget and a labor budget. So I want you to try this one out. We are going to look at it in the next class as we now do revision for the questions that as we do revisions for the questions that I gave out in the mock. So kindly make sure you also try the mock questions, because you're only left, I think, with one class and then you sit for the exams. So try out the mock questions. This one is inclusive of most of the questions that have been tested before. So try looking at them, and then try looking at those questions so that we can be able to now have an idea when we now do the comprehensive questions. For the last chapter, I say that that one is theoretical, so I had sent in some notes. Kindly go through them, kindly just read those notes, so that when we now meet in the next class, we will be able to discuss on the questions, revise a past paper, that so that now when we come across such questions in the exam, we can be able to respond to them. And with that, I'd like to wish you all good night. I'll also share the link to this recording so that if there's anything that you're not, that maybe we went too fast or something that is not clear, you can also just revisit this in future. And with that, I'd like to wish you all, the recording is available. All recordings are actually available on the virtual campus, the portal. So go through your If you go through your portal, you'll be able to see a link that leads you to the recording. I'll share this recording I think by tomorrow it should be up. I'll just provide the link, and then you can be able to follow that link and go through that recording. And with that, have a good night and see you in the next class. So next class, we'll just do revision of the past, the MOOCs that I gave you. So make sure you attempt that MOOC and have a good night.